you got, banks give a high interest rate for loans, is that because of the present value of what they think it'll be in the future, when they think it's gonna be paid, or does that have anything to do with it?
It's a lot to do with what the current market conditions are. And a couple of years ago, the rates were real low, so the mortgage loans were.
One thing we look at, and I don't know to what extent or degree you guys have talked about it in this shop, is yield curve analysis. And you mentioned the time value of money. We look at a yield curve, and there's slopes in yield curves. And a yield curve is simply, just a graph like this, where you have rates, percentages on this side, and time over here. And what we see now is almost in what we call an inverted curve, where it's like this, and it slopes off. So maybe this is 2 years, this is 5 years, this is 10, this is 20. There's no real benefit to extending out the yield curve. You're not getting more money. In fact, you would get less. So in a lot of cases, and these guys know a lot more about economics than I do, an inverted yield curve is the precursor to a recession. That's kind of been historically true. We don't think that's the case now, but the rate is mostly just a factor of economic conditions. And we make money on deposits, we pay some interest on that, or we make money on loans and we pay money on deposits. The difference is our net interest margin. That's what the bread and butter of banking is. That's banking
covers our overhead.
You charge a little more for loans than you pay for deposits. And that's your net interest margin. That covers your overhead and gives you profit to pay back to members or to your shareholders. So that's kind of that's a little bit on how you would determine a rate.
There's a question there, and then we get a question.
Oh yeah, what's the strategy?
And then back to
Kind of move the loan into the Fannie Mae or companies like that. Said you keep a service charge or something?
No, there's a difference between, we get a rate committed from Fannie Mae. It's generally maybe like to what we call 15 to 25 basis points, and that's like 0.15% or 0.25%. So if the loan is a $100,000 loan, that's $1,500 or $2,500, which doesn't sound like a lot, but if you do a lot of loans, it really adds up.
Arthur, I'm sure your institution and the other two institutions segue into this subject matter, track your delinquency ratios.
Oh, yes.
And would you care to comment on your ratio at your individual institutions right now?
We don't have any.
I can speak for only the first one. We have a zero. Umpqua Bank has been very good. That's why our earnings were up at the beginning of the year, because we had a zero delinquency. Zero. And we had some foreclosures. And what happens is, when you have a loan, and correct me, that's 90 days delinquent, by banking regulations, you have to charge that off. Then, if you can be fortunate enough to sell it and take that back into income, and hopefully you made money, it makes you look good, but that doesn't always happen.
So do you have any real estate foreclosure right now?
Not that I know of, not in Humboldt County. We could.
no one has to disclose any proprietary information here.
I don't know.
And ours, I should have Jim here more than.
No, that'd be publicly available information on the FIC's website. You can look at our quarterly call reports.
Yeah, and ours is about 3.9, but that's including everything we have on the portfolio.
And you do a lot more consumer.
And we do a lot more
yeah,
consumer
we do
loans than
auto loans, personal loans.
Right, so.
Harry?
Yes.
Oh, is that 3.9 on the increase?
No, as a matter of fact, we compare that to other credit unions in the country, and that's extremely low. So again, it's a different type of figure though that you were talking about, but no, as a matter of fact, it's been on a decrease.
So none of your institutions, as of yet, have been affected by the slowdown in the housing sales.
We sell our mortgage loans. Now, I cannot speak to our consumer loans. If I'd have known you were going to ask me that, I could have talked to the consumer loan department and asked what their delinquency ratio is. But it would probably be on our call report.
It is on the call report. And you guys, it's not really fair to compare us. We're only 31 months old. So if we had delinquencies, that would be a little bit of a problem. These are seasoned shops. They've been running and they're big.
Been in business for 54 years.
You're going to have losses. It's just the nature of the business.
Yeah.
It's how you handle them and what kind of risk or internal control measures you have in place to prevent them or reduce them that differentiates you.
Yeah, and I think we all have ours is called the collections department, Larry DeRitter, you know Larry.
Right.
But they don't just go out and say, hey, give me your house. I mean, they work with the member or the customer, trying to help them, because that's the nature of our business, is try to help them. Like with this $300,000 loan you were talking about, we want you to be happy with it. We want you to pay it off. We want you to keep your house. So we're gonna work with them. I think all of us do that.
I know we do have some SBA loans that are kind of, and those are loans that are governed, guaranteed by the federal government, and we have a SBA government guaranteed loan department in Eureka. It's the only one that we have on Quad Bank for California in Washington. And Bob Moore, who, Bob go to HSU?
Yeah, but he's not related to me.
No. He heads up our government guaranteed loan department, and I know they have some loans there that are.
Oh, I have two questions. They're kind of really off this subject. They're on banking. The first one was, I know that I'm considered the debt generation, and a lot of us in here are the debt generation. And I wondered, how does that affect banking and the loans and giving loans to people or in my age bracket, or the debt generation? Like, does that kind of deter you from giving us loans? And, or not deter, but is it harder for us to have loans and all that other stuff? Then the second question is really, really off the subject, but it's on banking. And this is just your personal opinion. For this class, we have to do a paper. And I'm writing my paper on how some Muslim cultures do not, they believe that interest is out. And I, because they have the whole thing of the thought of, if you really need help, you know, we don't want to make money, we're not trying to take more from you, we're trying to help you. So how do you guys feel about that type of like thought or
I'd like to tackle that first one, particularly since it's kind of a marketing question, but we look at our membership or customer base as in segments, and there are several segments as you go through life. Starting at the other end, where I'm kind of getting a little close to that other end, but I would probably not be marketed to very much for loans, because they figured I'd probably pass where I'm going to need a lot of loans, but they would probably target me for investments or deposits. But on the other end, on your end, probably Generation Y. There are things like student loans, having your first credit, getting a Visa card, maybe auto loans, those types of things. So establishing your credit would be very important. That's probably the way that the younger segment would be marketed. Then as you get into the family situation and so forth, then you get into the, as Martha was mentioning, the first-time home buyer. So you just sort of take your phases as you go through life.
But there's a regulatory issue. There's a thing called Regulation B. There's 9 prohibited bases from which we can make credit decisions: age, race, marital status, sex, religion, all kinds of bases. So when we look at you, we're not going, oh, man, she's one of those dead children. So we can't help her.
Yeah.
We are looking at you as we would look at anybody from a debt to income and a loan to value perspective. Dennis is right on point again for student loans and everything else, but the bank is prohibited from discriminating against you based on anything but credit discriminatory factors like your credit rating or how much debt you actually have. If you have too much to pay the loan, it's not in your or our best interest to give it to you.
And when you have credit, take care of it, because if you lose it, it's really hard
to build it back.
They're hard to build it back out.
Does it take 7 years?
Oh, it's
Or
just,
longer?
yeah.
It depends on if you file bankruptcy.
And if you have a checking account, nowadays the banks, if you don't maintain your checking account, they're gonna charge it off and send it to checks, and you are gonna have a hard time finding another bank that will open an account for you.
Sure.
So I